So we are accounting. This is a financial reporting class. Financial reporting and analysis. Financial reporting analysis. In our previous classes, we have done the accounting for the specialized companies like the provisional firm. We have done the conversion of partnership. We have also done the agricultural activities. We have done the pensions plans. And now today we are going to look at the published account. That is the presentation of the financial statement. So this published account, the published accounts is being governed by IAS 1 or IFRS 1. So it is being governed by IAS 1 or the IFRS 1. So they are the same. So what does the IAS 1 needs you as an accountant to do? So the IFRS needs you to have the three financial statement. The IFRS needs you to have the three financial statements. The financial statement. So what are these financial statements? What are these financial statements? My good learners? So when you talk of the financial statement, you are talking of the key three financial statement, which is a profit and loss account, profit and loss account, which we all know. The purpose of preparing the profit and loss account is to evaluate the performance of the company. Whether the company is making the profit or loss. And that, so this profit and loss account, for published account, you only need to know the components because we are preparing a published account which can be gazetted. So all of the workings, you will put aside all the working, and then you will bring in a summarized statement of financial statement or profit and loss account, which we need to know the components which form these are published. So the first component is the revenue. So you can write the key components, which we have the revenue, we have the cost of sales, and we have expenses has been categorized also into three. We have administrative expense or cost. We have distribution or the selling and distribution cost. We have the finance cost. So these are the components which you need to know for you to do a reporting. We have to do the revenue, the cost of sales, administrative, distribution, and finance cost in the notes. So we have what is called notes to the financial statement. So we will do it under the note to the financial statement. So once we are done to the note to the financial statement, then now we can bring to these summarized accounts or ledgers. We can bring to these summarized ledgers. So after that, we have something that remember, these are the main cost and the main revenue. So we have other revenue which are not being recorded here. Then that one we call it OCI, other comprehensive income. This other comprehensive income, it might be the revaluation. The revaluation gain or loss. It might be the revaluation gain or loss. So once we done with that, then we can prepare now another statement. Remember, we said we have the financial statement. So another statement is the balance sheet. Another statement is the balance sheet or SFB, statement of financial position. So another statement is SFB or the financial statement of financial position. And then now, lastly, we have statement of cash flow. Statement of cash flow. So this is what the IRS need you to prepare. So the IRS need you to prepare these three key financial statements. These three key financial statements. So once you have them, then we can have a look at the point of, or we can have a look at the format of the income statement. The format of the income statement. So the income statement, let's have the income statement format. So as usual, we start with the name, maybe a company. Statement of comprehensive income. Statement of comprehensive income. Statement of comprehensive income. Statement of comprehensive income. As at statement of comprehensive income as at that first maybe 01/2/2024 as at that date 2024. And then so as usual we start with the revenue. We start with the revenue. Cost of sales. We subtract that cost of sales for you to get gross profit. For you to get the gross profit. So once you have the gross profit, you less expenses. Admin cost. Distribution cost. Distribution cost. Finance cost. Finance cost. That one will give you the total expenditure. The total expenditure. So if you subtract, you get the profit before tax. You get the profit before tax. You get the profit before tax. And then we less tax. We get the profit after tax. We get the profit after tax. So once we get the profit after tax, we say add OCI. Remember OCI, we said other comprehensive income. So maybe we have revaluation. So that we get the total ICO, that is the total comprehensive income, total CI, that is the comprehensive income. So once we have the format, then now we can look at the illustration. So let's look at the illustration. Let's look at the illustration. So we can have the illustration. So illustration is for the month of April 2022. Let's get the best paper. Documents za hizo vitu. 2019. So mwambia 2019 kwani kampuni ilianza cooperate lini? Yes. So we have April 2022 question 3. Question 3, that is the
kwani wanafanya nini
for the millennium. So the company year is April 2022. Question 3, that is Millennium Limited. Millennium Limited. So we have been told that the following trial balance was prepared by the Millennium Limited as at 30th June 2021. So we have been given the trial balance there from the ordinary shares all the way to the share premium. So we are not going to go through the values of the trial balance. Make sure that you have the past paper for the April 2022 question 3. And then, so what our main concern in notes is the notes, which we are going to see note 1. We have been told the sales proceeds include the customer deposits of 4.2 million, which Millennium Limited accounted for by debiting the bank and crediting the sales. So that's very important. And this published account, they only test the knowledge of accounting, either from the financial accounting to the financial reporting. That's why it is called the published account. So it can be the account for the manufacturing, it can be the account for the restaurant industry, construction company, the professional firm. So it combines all the account, also the group's account. But now you have to know it's just the knowledge of what reporting, but you have to have that knowledge of the what accounting principles. That's why that note it is testing for the double entry. The first note is testing for the double entry. So this guy has recorded the cash proceeds. The customer's deposit as recorded as a cash as a sales again. So that one is a double recording. So we have to correct that channel by having notes. Remember we said financial reporting of published account, we only publish the main account notes. We keep note of the financial statement. So we will start with the note 1. Start with the notes, which is note 1 is for the revenue account. The revenue account. The revenue account. So tutaandika hapa as per trial balance, as per the TB, that is the trial balance. So what is the revenue for as per the trial balance? The revenue as per trial balance there, I can see 283,486. 283,486. I will subtract the customers deposits less customers deposits less customers deposit of how much? Go to note number 1. Go to note number 1 of 42 million. Remember we have 3 zeros here, so I will subtract 4,200 for me to arrive at the adjusted revenue. The adjusted revenue is how much? Take your calculator. 283,486 minus 4,200. We are getting 279, 260. So that is note number 1. Note number 2. Note number 2. We go note number 2. We are going as per the additional information. Number 2, we have been told the cost of inventory as at 30th June 2021 was valued at 16 million. These goods include goods whose cost were 450,000, replacement value of 400,000, fair value of 500,000, with a selling cost of 80,000. So these affect the cost of sales. This affect the cost of sales. We have to do the adjustment of the closing inventory. So we have the closing inventory here. Write for me closing inventory. Write for me closing inventory. As per the trial balance or TB, I've seen 16,000. Remember, we have other 3,000, 3 zeros up there. So we will less what they have replaced. So less the replacement. The replacements or goods replaced. Goods replaced of what? 450. 450. And that we need to add the fair value. The fair value of a purchased or the replaced item, which is 500,000 minus 80. This one will come to 420. 420. So add to get the adjusted closing inventory. So 16,000 minus plus 450 minus 420. I'm getting 16. No, we have to list, yes, 16,000 minus 450 plus 420. I'm getting 15,970. So this is the adjusted closing inventory. That is the adjusted closing inventory. So once we have adjusted closing inventory, we are still in note 2. We said the closing inventory affect which item? It affects the cost of sales. So we will come here, write our cost of sales, right? Our cost of sales. How do we prepare the cost of sales, my good learners? How do we prepare the cost of sales? We normally take the opening stocks, we add the purchases, we less the drawings, also the carriage inwards if it is there. We also less the closing inventory so that we can arrive at the total cost of sales. But do we have all those items I've mentioned? Let's look at it. So we have the opening inventory. Opening, I can write OC, that's standing for opening inventory. Go to your trial balance. Go to your trial balance. Trial balance equal P. We have the value there. Inventory as at 1st July 2020 of 12,400. We add the purchases. We add the purchases, which look at the trial balance. I can see the purchases of 147, 200, 147, 200 before we less the closing stocks. Remember, this is the published account, and in most cases, even when you are preparing the published account, a good example is that you are working in a manufacturing company. This manufacturing company, they have the laborers who involve directly in the productions of goods. So those cost of the labor will be included in the cost of sale. Even to the factory itself, you will have the depreciation for the factory. So that depreciation value will be included in the cost of sales. That's why I cannot bring in the closing inventory immediately before I see other adjustment. Let's look at the classification of depreciation. Let's look at the classification of depreciation, which I will go to note number 4. Number 4. There's a lot of information there, but not number 5 is for depreciation. Other assets are being depreciated as follows: plant and equipment, 20% per annum on a straight line basis, and then furniture and fitting at 25% per annum on a reducing balance method. Okay, then depreciation is classified as cost of sales except depreciation on furniture and fitting. And furniture and fitting, which is classified as administrative cost. So we have known that all the depreciation are classified as cost of sales except the furniture and fitting. So we will come here and have depreciation. So we can have for building first, plant and equipment. Plant and equipment. Now for plant and equipment is 20% on a straight line basis. 20% on a straight line basis. When we say on a straight line basis, we multiply by the cost direct. So let's have the cost of plant and equipment, which I can see 55,000. 2 times 5, that is 11. I divide by 100. So we can have 11,000. Is it 11,000? 20%. Yes, 11,000. What about the building? Building, we have been told, look at the note there, up there. The land and building are carried under the revaluation model as permitted by IFRS. The most recent revaluation take place on 30th June 2019, resulting in the fare included in the trial balance above. The revaluation surplus of that one. So we are finding out the cost of. So we have been told we will take. We can see the useful life of 50 years on the as at the date. So the building has a 50 years useful life. So we'll take the cost, which the cost we have to separate the land and building. So you can see the cost of building the land is 16 million. So you take 56 million minus 16. We divide by 50. We divide by 50. We divide by 50. So it will be 56 minus 16. 56 minus 16. We divide by 50. Time is 1,000. So we getting a depreciation of 800. So once you get a depreciation of 800, we less the closing stock, less the value of closing stock, which is this one, 15, 15, 9, 70, 59, 70, 59, 70. So what is the value of the cost of sale? So it will be 12,400 plus 147, 200 plus 800 plus 11,000 minus 5970. So we are getting 155 430. So that is the value of cost of sales. So now I have two components which I can indicate here: revenue, so that I will not forget. Revenue, we have 279, 260, and then cost of sales. Cost of sales, we have it here, 155 for 30, 155 for 30. So I think we can go now to note 3. So we have done with note number 1 and 2. We can go to note 3. So let's look at note 3. So we are doing note 3. So note 3, so we have dealt with note 5. Note 3, I can see that one is for what? It is for revaluation. So that one is for revaluation. So revaluation, gain and loss will come there. But we can't do note 3. I can see note 3, 6% debenture were issued on 1st October 2020 at a par value. So interest on debenture is payable semi-annually. So we can't have interest on debenture. So interest on debenture fall under which classes of expenses? So it fall under the finance cost. It fall under the finance cost. So we will have the finance cost here as note 3. Finance cost. So we have the debenture, which is 6% of the value of debenture. I can see 10,000, but we have been told it was paid semi-annually. And when was this debenture issued? It was issued on 1st October 2020. So October 2020 to the date of our closing period. Remember, if you draw the accounting period here, we are ending these books on the 30th June 2021. So which means we started this on 1st July 2020. And now we are getting a debenture on 1st October 2020. So how many months are we remaining here? That is 9 months. So we are remaining with 9 months. We are remaining with 9 months. So here I will multiply by 9 over 12. I will multiply by 9 over 12. So let's get the value. 6% of 10,000 times 9 divided by 12. I'm getting 450. Getting 450. So that is a debenture. Now go back to the preference share. Go back to preference shares Go back to the preference shares. In the preference shares, there is a two-way of accounting for the preference shares. There is a two-way of accounting for preference shares. There's two-way of accounting for preference shares. Like we have to consider, does these preference shares have the financial obligation to the company? Does these preference shares have the obligation to the company? And how do we know that these preference shares have the financial obligation to the company? We look at the nature of the preference shares. Is it irredeemable preference shares? If it is irredeemable preference shares, it means you cannot redeem that shares. It can't stay there in the company for more than even 20 years, and it has no obligation or financial obligation to the company. But if it is irredeemable, which means the owner of the preference shares can redeem this preference within a given period, maybe 6 months, 2 months, 1 year, and it will lead to the financial obligation to the company. The company has to pay. So in that case, it means it will fall under the finance obligation or the finance cost. Look at the nature of the preference shares in our trial balance. We have been told 8% redeemable preference shares. It is redeemable preference shares. So it attaches a financial obligation to the company. So you will not record it under equity and liabilities, but under equities or the equity shares. So it is the liability. It is the liability. So we will take that here, 8%. 8% of the value of the preference shares. How much is the value of the preference shares? We have 12,000. 12,000. 8 times 12, that is 6,196. We divide by 100. So this is 960. So add the 2, 0, 1. This is 5 plus 9, 14. So our finance cost is for 1410. So we have the finance cost here. We have finance cost here 1410. We have finance cost there 1410. Then we go to the note, another note, which is this note now. We have done with finance cost, so we are remaining with distribution cost and administrative cost Administrative cost, depreciation will affect that. So let's go to the that note, administrative cost. That is not 4. Administrative cost. So as per the trial balance, is how much? As per the trial balance is how much? As per the trial balance is how much? Administrative cost as per the trial balance. I can see 34,440. 34,440. Then we will have the depreciation. We have depreciation on furniture, which we have been given. Depreciation on furniture, not number 5. 25% on a reducing balance. 25% on a reducing balance. So when you say on a reducing balance, we multiply by the net book value of the assets. So what is the net book value of the asset? Because you have to take the accumulated depreciation minus, or the cost minus accumulated depreciation. So if you go back to your trial balance, you can be able to see the cost of 35,000. I will negate or subtract accumulated depreciation on furniture and fitting. That is 9,600. Then I multiply by 25%. So take your calculator. I don't want people using the phone for calculation. So 35,000 minus 9,600 times 25%, we are getting 6350. So I haven't seen any other notes which is touching the administrative expenses. So in that case, we can add the two. We can add the two and get our values. So plus 34,440, which this one will come to 40 as 790. So we have admin cost here of
Ba di
40,
kia ina
790. So let's look at the distribution cost. Is there any adjustment for the distribution cost? You go all through the additional information and look at whether there is adjustment for administrative distribution cost. Distribution cost. Remember, the only note which we haven't touched here is note 7 and 8, but all them are for taxes. Note 5 we have done with that. Note 4 we have not done with that, but there is no expenditure there. There is no expenditure. So which means we don't have the note which is affecting the distribution cost. So how much is the distribution cost there? So from there now, we can prepare our statement up to the profit before, or we can even list here so that we can prepare them because it will be copy pasting. I can see distribution cost 23,300, 22,300, 22,300. So what else is remaining from our format? So we haven't seen any other incomes. So we haven't seen any other income and tax account. That is the only thing which is remaining as per our format. So this is depreciation for furniture and fitting, 63.50. So don't forget that, 63.50. So if we go back to the note number 4, we have been told land and building are carried under the revaluation model as permitted by IFRS. The most recent valuation took place on 30th June 2019, resulting in the value included in the trial balance above. The revaluation surplus of that 3.4 were resulted solely from the land and building. The building is estimated to have a useful economic life of 50 years. The land was revalued 18 million and the building was revalued 34 million. So let's get that. That one will be not 5. So we have the revaluation here. Revaluation. So first you can start with building. Is it building or land? The land. So you can start with the revaluation of land. So revalued amount of land is 18,500. Don't forget other 3 zeros. 18,500 as per the trial balance. As per the TB, we have 16,000. So the difference is the revaluation gain. The difference is the revaluation gain of how much? 005 to 2,500. We have revaluation gain of 2,500 for land. And then to come to building, balance as per TB or trial balance. As per trial balance is how much? That is 16 million, the value of land minus the total value of land and building combined, 56 million. So which means the value of building itself is 40 million. So we'll have 40,000 here, 40,000. And then let's look at the revalued amount. Let's look at the revalued amount, the net book value of what? Revalued amount. The net book value of what? Revalued amount. The net book value of the revalued amount. So we will take the, no, we have been given the net book value of the revalued amount, but we want to get the net book value of this 40 million. So sorry, is not the revalued amount, but the net book value of cost, which we have 40 million less depreciation, accumulated depreciation. So go to the trial balance. What is the accumulated depreciation for building? 8,000. So I will less 8,000. Also less depreciation charge for the year. Which we have already calculated that one. Ilikuwa ngapi, my good people? Ilikuwa 800. I remember 800. So subtract this so that we can get the net book value. 40,000 minus 8,000 minus 800. I'm getting 31,200. So this 31,200 This 31,200 is the current net book value. So as per the accounts, so we can say as per the accounts is 32,200, and then revalued amount we have been told 34 million, which is that 400. So the difference is the revaluation gain. The difference is the revaluation gain of how much? The difference is the revaluation gain of how much? 34,000 minus 32,200. So we have revaluation gain of 2,800. So we add the two, we get the total revaluation. We get the total revaluation. So plus 2,500. So we have the total revaluation here. The total revaluation of 5,300. That is the total value of revaluation, 5,300. So after that, we go to the income tax account. So let's look at the income tax account as our note number 6, as our note number 6. So we have note 6. This is income tax. Income tax. So make sure that you are asking question on the comment section where you don't understand. You pose a question to there so that you can be able to answer you. So that we can be able to answer you. So how do we treat the taxes? So you must be in the class of accounting for income tax. Have you ever been in my class of accounting for income tax? So you must be understanding the income tax session. So the income tax, or the IAS 12, that is the income tax, will enable us to differentiate what is deferred tax, what is a taxable temporary different, what is a deductible temporary different, and how to treat them. So in that case, if you look at the examiner here, the examiner has given you the deferred tax asset in your trial balance, and it is in which side of the your trial balance. Is it in the debit or the credit? Because the examiner is not as specific, here. He has just mentioned deferred tax. Is it a deferred tax asset? Is it a deferred tax liability? We don't know. But with the concept of debit and credit, which you have learned it in the financial accounting, then you can be able to know, is this an asset or a liability? So with the knowledge of financial accounting, this is a liability. This is a deferred tax liability. This is a deferred tax liability. This is a deferred tax liability. So look at the note number 7. A taxable timing difference for the year amounted to 45 million, while the deductible timing difference were 24 million. So this is a good examiner. This is a good examiner. Why am I saying this is a good examiner? He didn't want you to have a lot of time calculating the timing temporary, the timing, taxable timing different and deductible timing temporary or the difference. Remember this taxable timing difference, it is resulting from the difference between the carrying amount and the tax base. The carrying amount and the tax base. So the examiner have already calculated that one. They have now given you the two. So the first one, which is a taxable timing difference, is a positive, and the other one is a negative. So which means the negative one is an asset and the positive one is a liability. So we have now, so you will come here and write the provision. So we have deductible or taxable timing different and deductible timing different. So the other one is we have 45. So you will take 45,000 minus 2,400 or 24,000, sorry. So that one will come how much? 45 minus 24, we get 21. We get 2,100. From here, we take 30%. We take 30% times 30. We get 63. So we get 63. So this is our deferred tax. This is our deferred tax. So this is our deferred tax. So this deferred tax, as per the trial balance, as per TB, we have what? 5,200. So the company or this Millennium company had provision of what? 5,200. But now, based on the data which we have been given maybe by the Kenya Revenue Authority, is what? 6,300. So is it over provision or under provision? So it is under provision, which if you have under provision, it results in increase in the income tax. So we have an increase, in provision, we have an increase in provision, of how much? 0,011 of 1,100. So Millennium company has to pay this 1,100. Millennium company has to pay this 1,100. It has to pay this 1,100. And so now we have the corporate tax, which they are provided there in note number 6. A provision for the corporate tax of 24.5 million for the year ended. So we will take that 24.5 plus this, So that now we can now have our comprehensive statement of financial or the profit and loss account. That is very simple. Now, having all these figures, then that now it will be the walk in the park. It will be very easy. So we have 1,100 here, so don't forget. So that one will be very easy. Having this, that one will be very easy. So and actually, this is what normally the auditors does. You accountant, you provide all the notes, you does all the notes, the auditor will come and pick the notes you have, and then they start doing reporting, which they don't have a lot of work. So we write here Millennium Limited, the statement of comprehensive income, CIO, asset, 30th June 2021. We start with the revenue. I can see the value of revenue there, which is 27926 less cost of sales of 155 430. We get our gross profit. Expenses, I can see finance cost of 140. Admin cost of 40,790. I can see distribution cost of 2322 300. That one will give us the total expenses. So let's get the gross profit. Let's get the gross profit, which is 279 to 60 plus minus 155430, getting 123 830. We subtract all the expenses minus 1410 minus 4079 minus 22 300, which you are getting 59 330. 330. So this is the profit before other profits. And so we can add other profit, the direct profit, not the one which is coming from the revaluation. So we have the investment income there. You can see investment income of 1500. So add investment income of 1500, so that you can get the total profit there. So plus 1500 can get 60,830 less the tax, which we have 24,500 plus 1100. So total will come to 24,500 plus 1100, come to 25,600. So subtract minus 60 or 6830 minus answer. We get the profit before tax of 35 to 30. So this is the one which you will take to the profit to the statement of financial position. This is the one which you will take to the statement of financial position. And now we can add other, OCI, the other comprehensive income, which we have the revaluation gain of 5,300, so that you can get our total comprehensive income. Our total comprehensive income of how much, my good learners? So plus 5,300, you're getting the total comprehensive income of 40,550. So that makes the first attempt of this question. That is number one. It was requiring the statement of comprehensive income for the year ended 30th June 2021. So this is it. You can see the first thing you have to do is to prepare the notes. And then once you prepare the notes, you now bring in, you come here and prepare the statement of comprehensive income. So that is it. So our next approach is the statement of financial position, which we also need to prepare the notes. We will prepare the notes either from the changes in equity, the PPE account. We prepare the PPE account. We prepare the accruals accounts and the prepayment account, and then from there also we do the reporting. So that is it. So let's have a few breaks and we go back to